In 1998, a hedge fund built on advanced mathematical models came within days of triggering a global financial crisis. Long-term capital management was run by top traders and Nobel Prize-winning economists, managing billions with extreme precision. At its peak, the fund controlled positions worth over $100 billion, supported by leverage that amplified even small market movements. The strategy relied on the assumption that market relationships would remain stable over time. But when those relationships shifted unexpectedly, the model began producing losses instead of profits. As positions moved against the fund, leverage turned small deviations into rapidly expanding losses. Within weeks, the fund was losing hundreds of millions, then billions, as liquidity disappeared from the market. At that point, failure was no longer contained to the fund. It threatened banks and financial institutions connected to its positions. What followed was an emergency intervention to prevent a collapse that could have spread across the entire financial system. In 1994, long-term capital management was founded with a strategy built on identifying small pricing differences across global financial markets. The idea was to profit from convergence, assuming that related assets would eventually return to stable historical relationships. Backed by strong early performance, the fund attracted capital from major investors and financial institutions. Its credibility was reinforced by leadership that included highly experienced traders and academic experts in financial theory. As confidence increased, the fund expanded its positions across bonds, currencies, and derivatives worldwide. To amplify returns, LTCM used significant leverage, borrowing large amounts to increase exposure to relatively small price movements. This allowed the fund to control positions far larger than its actual capital base. At this stage, the system appeared controlled, but it depended entirely on stability and the ability to exit positions when needed. As positions expanded, the strategy became increasingly dependent on mathematical models to measure risk and predict convergence. These models were built on historical data, assuming that market relationships would behave within known ranges. Small price differences were treated as temporary inefficiencies that would correct over time. To maximize returns, LTCM scaled these trades using leverage, increasing exposure while assuming limited downside risk. The system worked as long as markets remained liquid and correlations held steady. But the models did not account for extreme scenarios where multiple markets could move against the same positions simultaneously. At this point, risk was not eliminated. It was compressed into assumptions that had not been tested under stress. The fund was now operating at a scale where even minor deviations could have amplified consequences. In 1997 and early 1998, global markets began showing signs of instability as financial stress spread across multiple regions. Events like the Asian financial crisis disrupted capital flows, increasing volatility across currencies and bonds. Instead of converging, price differences began widening, moving against LTCM's positions. Losses started to accumulate, but the fund maintained its positions, expecting markets to revert to historical patterns. To stabilize performance, additional capital was deployed, increasing exposure rather than reducing risk. At this point, the system was no longer adjusting to the market. It was committed to a direction that required reversal to survive. Liquidity conditions also began tightening, making it harder to exit positions without affecting prices. What appeared to be temporary divergence was becoming a sustained shift the models had not anticipated. In August 1998, Russia defaulted on its debt, triggering a sudden shock across global financial markets. Investors moved rapidly into safer assets, causing price relationships to break across bonds and currencies. Instead of converging, the spreads LTCM depended on widened sharply, moving further against its positions. Losses accelerated as leverage amplified each unfavorable movement across multiple markets at once. At the same time, liquidity began to disappear, making it difficult to reduce positions without driving prices further. The fund's size meant that exiting trades would impact the market, locking it into worsening positions. What had been calculated risk now became exposure to a market that was no longer behaving predictably. By this point, the system had shifted from controlled strategy to a rapid and expanding loss cycle. As losses deepened, LTCM's capital base declined rapidly, reducing its ability to absorb further market movements. The firm attempted to raise additional funding, but confidence among investors and counterparties began to weaken. Banks and trading partners started limiting exposure, tightening credit conditions around the fund. This reduced flexibility at the exact moment the strategy required more liquidity to survive. Positions that could have been managed under normal conditions became increasingly difficult to control. At this stage, even small market moves continued to generate outsized losses due to remaining leverage. The fund no longer had a viable path to stabilize its positions independently. What had been a temporary stress scenario had now locked the system into a trajectory toward failure. By September 1998, LTCM's positions were so large and interconnected that its failure threatened multiple major banks. A forced liquidation would have pushed prices further, creating losses across the financial system. At this stage, the issue was no longer the fund itself, but the impact its collapse could have on global markets. Major institutions had exposure through loans, derivatives, and counterparty relationships with LTCM. If the fund defaulted, those connections could trigger a chain reaction across financial markets. Liquidity was already fragile, meaning any large-scale unwind could accelerate instability. The situation had moved beyond a private failure into a broader systemic risk. Without intervention, the collapse of one fund had the potential to spread across the entire financial system. In late September 1998, major financial institutions coordinated a bailout to stabilize long-term capital management. The rescue was organized to prevent a disorderly collapse that could have disrupted global markets. LTCM's positions were gradually unwound under supervision, reducing pressure on the financial system. The fund's equity was largely wiped out, ending its operations as an independent entity. The event exposed how leverage and interconnected positions could amplify risk beyond a single firm. It also revealed the limits of models built on assumptions of stable market behavior. What had been seen as a highly controlled strategy proved vulnerable under extreme conditions. The outcome became a defining example of how financial systems can be destabilized when risk is concentrated and amplified.